Imagine for a second that your trusted financial advisor calls you into their office.
Okay.
And they look you dead in the eye and tell you to take every single penny you own, liquidate it all, and put it into experimental digital tokens.
Right, which sounds terrifying.
Exactly.
Yeah.
So you do it. But then you look out the window and you see that same advisor immediately turn around, walk to a hidden vault in their backyard, and start frantically burying solid gold bars under the floorboards.
Oh, wow.
Yeah. You'd probably call the authorities, right? I mean, you would instantly assume you were being scammed.
It's the ultimate bait and switch, a total breakdown between the public advice they are giving you and the private actions they are taking with their own wealth.
Right. And yet, according to the source material for today's deep dive, that scenario isn't just a hypothetical about one shady advisor.
Not at all.
It is playing out right now on a massive macroeconomic scale.
Yeah, it really is.
So we are looking at a highly detailed document titled Van Bundut Den, and our mission today is to impartially unpack its central thesis.
Which is pretty heavy stuff.
Oh, absolutely. This text claims we are living through what it calls the great monetary paradox.
Right.
The core argument is that the very architects of our global financial system, central banks and mega institutions, are hoarding physical assets at record rates.
While simultaneously pushing the retail population, meaning you and me, into a fully digital, cashless system.
Exactly. It's a sweeping, highly provocative premise.
It is. And, we should establish a clear baseline right from the jump here.
Yeah, please do.
The claims made in this text are intense. They point toward a massive systemic shift in the underlying mechanics of the global economy.
Right. And just to be clear for everyone listening, our goal today isn't to take a side.
Exactly. We're not endorsing these macroeconomic theories or offering financial advice.
Well, definitely not.
Our objective is simply to lay out the data, map the timelines, and explore the underlying arguments presented in this specific document.
So that you can understand this perspective.
Right. What's fascinating here is the assertion that we aren't just moving toward digital convenience, but that we are witnessing the deliberate creation of a dual-layer economy.
A dual-layer economy. That's a wild concept.
The text argues the financial system is intentionally bifurcating into two entirely different sets of rules.
Like a separate rule book for the elites.
Yeah, exactly. A physical, tangible foundation for the institutional elite and a restrictive digital layer for the everyday citizen.
Okay, let's unpack this because to understand the paradox we just introduced, we actually have to go backward.
Right, back to the source.
Yeah, the source material insists that to grasp what's happening right now with digital money and physical gold, you have to look at when the current rules of the game were actually written.
And the authors point directly back to the 2008 Great Financial Crisis.
The 2008 crisis. I mean, that seems to be the starting point for a lot of these theories.
It serves as the foundational bedrock for this entire theory, actually. The document views that meltdown not simply as a housing bubble that popped, but as a catastrophic failure of hypothecated assets.
Hypothecated assets. That's a heavy piece of financial jargon.
It is, yeah.
Break down the mechanics of hypothecation for us.
Sure. So at its core, hypothecation is when you pledge an asset as collateral for a loan while keeping ownership of it.
Like a mortgage.
Exactly, like a mortgage. But the text explains that in the lead up to 2008, financial institutions warped this concept entirely.
How so?
Well, they were creating extremely complex derivatives, which are essentially just paper promises,
right,
and layering them on top of other paper promises. They were taking one underlying asset, like a bundle of subprime mortgages, and creating multiple derivative bets based on it.
So it was just astronomical leverage built on leverage.
Exactly. And when those underlying mortgages began to default, the entire tower of paper promises imploded.
The systemic contagion.
Right. It nearly brought down the entire global financial architecture.
So the central banks stepped in with quantitative easing.
They did.
Which, looking at the text here, is basically a very academic-sounding way of saying they printed a tidal wave of fiat currency to bail out the system.
Yeah, they basically flooded the zone with liquidity to extinguish the immediate fire.
Right.
However, the document argues that by choosing this specific mechanism, central banks effectively guaranteed the slow-motion collapse of fiat purchasing power.
Because they injected trillions of newly created currency units into the system.
Exactly. The authors claim they mathematically locked in a future where the currency would aggressively devalue over time.
Wow.
And crucially, the text asserts that the central bankers fully understood this long-term consequence.
Wait, so if the architects knew the currency was eventually going to devalue, they couldn't just sit on their hands.
Right, they had to prepare.
They'd have to rewrite the rules before the system cracked again. Is that where the Bank for International Settlements steps in?
Yes,
Because the text calls them the central bank for central bank.
Oh. They do. The document points to the Bank for International Settlements and their rollout of the Basel Third Accords as the major turning point.
The Basel Third Accords?
Yeah. These accords were publicly marketed to the world as a vital safety measure.
The mainstream narrative being that these strict regulations would force commercial banks to hold enough high-quality capital to prevent another 2008.
Right. But the authors argue that buried deep within the complex formulas of that regulatory framework was a monumental shift in how the system categorized physical gold.
Okay, this is the part of the document that really blew my mind.
It's wild, isn't it?
It really is. It's like playing a video game where your absolute strongest armor is suddenly nerfed by the developers, but some clunky, outdated item you've been ignoring for years is suddenly upgraded to be the most powerful weapon in the game.
That analogy fits perfectly with how the authors describe the shift.
You're forced to completely alter your entire strategy.
Absolutely. Because under the old rules, pre-Basel III, physical gold was classified as a Tier 3 asset for commercial banks.
Which meant it was practically radioactive on a balance sheet.
Pretty much.
Why did regulators hate physical gold so much back then?
Well, because physical gold is heavy, it's clunky, and it requires secure transport and vault storage.
Right, it's a physical thing.
Yeah, it isn't instantly liquid like a digital bond. So regulators subjected it to severe haircuts.
What does that mean in practice?
If a bank held, say, $100 million in physical gold in its vault, regulators would only allow them to count about 50 million of that toward their actual reserve requirements.
That is a massive penalty.
It was. The text explains that this actively discouraged banks from holding physical, tangible assets.
Pushing the entire banking system toward holding paper derivatives and sovereign debt instead.
Right, because those were treated as safe, liquid, and fully valued by the regulators.
But then Basel III comes along and flips the entire board upside down.
It was a massive structural reclassification. Under the new Basel III regulations, unallocated physical gold was suddenly upgraded to a Tier 1 risk-free asset.
Wait, a Tier 1 asset?
Yeah. Practically overnight, it went from carrying a 50% penalty to carrying the exact same regulatory weight as physical cash or U.S. Treasury bonds.
Around 100% valuation.
Exactly. And simultaneously, the regulations began to heavily penalize paper gold.
Meaning exchange-traded funds and derivatives.
Yeah, anything that gives you price exposure to gold but doesn't have direct one-to-one physical backing in a vault.
So the rulebook basically screamed at the major financial players, hey, the paper game is incredibly risky. Now get your hands on the physical, tangible metal.
Exactly. And according to the sovereign purchasing data cited extensively in the text, that massive shift in the rules triggered a massive shift in behavior.
Okay, let's look at those numbers, because the statistics highlighted in the source are just staggering.
They really are.
We are talking about central banks quietly emptying Western vaults.
Yes.
The text shows their net purchases of physical gold have been shattering historical records, frequently exceeding 1,000 tons annually in recent years.
1,000 tons?
Yeah, and it specifically names the People's Bank of China, the Central Bank of the Russian Federation, and the Reserve Bank of India as the primary drivers of this accumulation.
Right.
But just logistically, what does 1,000 tons of gold actually look like? How do you even move that?
I mean, it requires an incredible amount of secure logistics. We are talking about fleets of armored trucks, heavy cargo planes, and highly secured, deep underground storage facilities.
It's not a small operation.
No, not at all.
Well,
It involves complex verification processes, assaying the metal to ensure purity, and military-grade security.
wow.
The document emphasizes this physical reality to make a point. This isn't just a spreadsheet update.
Right.
This is the heavy, expensive physical movement of actual wealth.
Which brings us to the why. I mean, why go through all that trouble?
Well, if we connect this to the bigger picture, the text argues this is absolutely not mere portfolio diversification.
Because central banks don't undertake the logistical nightmare of moving thousands of tons of physical gold just to hedge a few percentage points.
Exactly. The authors frame this as an explicit, calculated preparation for a massive fiat devaluation.
Because they mathematically know the current global debt burden is a dead end.
That is the core assertion, yes.
Right.
The global debt is mathematically unsustainable.
Right.
The document posits that central banks know hyperinflation, devaluing the currency, so that the insurmountable debt becomes practically cheaper to pay off.
It's the only viable mathematical escape hatch.
Exactly. And the authors argue that when a currency hyperinflates, the only entities that survive with their purchasing power intact are those holding unencumbered, tangible physical assets.
I'm tracking with the logic so far, but I have to push back here.
Okay, sure.
As I was reading this section, a glaring contradiction jumped off the page.
What's that?
If physical assets like gold are the ultimate safe haven and these central banks know it, why are these same central banks spending billions upon billions of dollars to develop CBDCs?
Central bank digital currencies.
Right. If tangible gold is the real power, why build a massively complex digital ocean for everyone else to swim in? It feels like a total contradiction.
It certainly looks like one, yeah. But the document offers a rather chilling counter-argument to that exact point.
Okay, what is it?
It suggests that central bank digital currencies are not meant to be an evolution of money. Rather, they are designed as an evolution of behavioral control.
Behavioral control.
Yeah.
Walk me through the actual tech there. How does a digital dollar restrict my real-world actions?
It all comes down to the underlying architecture. A CBDC isn't just traditional digital money, like the balance you see on your current banking app.
Right, it's different.
It is a programmable ledger. The central bank's code sits directly between your digital wallet and the merchant's payment terminal.
Okay.
Because it is programmable, the central authority can write smart contracts directly into the currency itself.
Meaning the money has rules attached to it before you even try to spend it.
Exactly. The text gives the example of negative interest rates. During an economic downturn, a central bank could theoretically program your digital money to lose value if you don't spend it by a certain date.
That's terrifying.
It forces the population to stimulate the economy, stripping away the ability to save.
The document also talks about geofencing the capital.
Yes.
Like, they could restrict your digital wallet from working outside a specific radius from your home address if there were a lockdown or a crisis.
Exactly.
But the kicker, tying it back to the gold hoarding, is asset restriction.
And this is where the authors tie the two concepts together.
Okay.
If the state determines that too many regular people are trying to flee the devaluing fiat currency by buying physical gold, they don't actually have to pass a law banning the ownership of gold.
You just tweak the code.
Yes.
Wow.
They simply program the CBDC ledger to automatically reject any transaction at a merchant whose category code is registered as a precious metal dealer.
Wow.
When you tap your card or your phone, the smart contract simply refuses to validate the block. The transaction fails.
The money simply won't work there.
Exactly. The text argues that a fully implemented CBDC network acts as an inescapable containment strategy to prevent capital flight.
So, summarizing the source's core thesis here, it's describing a two-tiered civilization.
It really is.
You have the architects, the central banks,
Yeah.
operating in this shadow physical economy.
Right.
They use the Basel III regulations to hoard Tier 1 physical gold, which they will use to settle debts among themselves and preserve their wealth.
Meanwhile, the 99% are being ushered into a closed-loop, programmable digital cage that is permanently tied to a devaluing currency.
That is just, it's a profound bifurcation the text is warning about.
One physical, unencumbered set of rules for the elite, and a highly restrictive, purely digital system for the retail public.
That paints a grim picture for the future.
Yeah.
But, what about right now?
Right.
The average person listening to this probably has a retirement account, maybe a brokerage app on their phone.
Sure.
They log in today, they see their shares of an index fund or a tech stock, and they feel totally secure. They feel like they own those assets.
And this raises an important question regarding the illusion of ownership versus the legal reality of ownership.
Yeah.
To understand the risks, the source text leans heavily into the legal concept of the chain of custody.
Wait, let's slow down. The text mentions assets being held in street name by a prime broker or a centralized depository.
Right.
Does that literally mean my name isn't on the deed to the stocks I bought with my own money? Walk me through what a centralized depository actually does.
It is a shocking realization for many, but yes, decades ago, if you bought a stock, you received a physical paper certificate with your name on it. But in the late 1960s and 70s, as trading volumes exploded, Wall Street physically couldn't handle the paperwork.
The system choked.
It did. So they created centralized depositories like the Depository Trust and Clearing Corporation, the DTCC.
So they digitized the paperwork.
They did more than digitize it. They pooled the legal ownership.
Oh, wow.
When an average retail investor clicks buy on an app today, they very rarely hold the actual legal title to that specific share.
Wait, so who holds it?
The legal title is held in street name by the broker or the depository. Your account simply reflects a contractual claim against the broker. You own an IOU.
And because the prime broker holds the legal title, they can use it.
Exactly. We return to that critical term, hypothecation.
Right.
The institution legally uses the asset you paid for as collateral to secure their own trades, their own leverage, and their own loans.
That is wild.
And the text highlights that these assets are often rehypothecated multiple times.
Meaning?
One single piece of underlying collateral might be mathematically supporting 5, 10, or even 20 different derivative contracts across the financial system.
It's like a massive high-stakes game of musical chairs.
That's a great way to look at it.
The music is playing, everyone is dancing around looking at their brokerage apps and feeling totally secure because their screen says they have a chair.
Right.
But in the physical legal reality, there's only one real chair for every 5 players in the game.
That captures the dynamic perfectly. And the systemic contagion reality, which the authors of the document insist is an absolute mathematical inevitability, occurs the moment the music stops.
What actually happens when the music stops? Let's say a massive hedge fund or a prime broker suddenly goes bankrupt.
When one major player defaults, it triggers a cascading liquidity crisis.
Right.
Suddenly, everyone in that chain rushes to claim their underlying asset. But as your analogy points out, there's only one chair for 5 people.
So what do?
When that happens, the legal fine print that you scrolled past and clicked agree to when you open that brokerage account is fully activated.
They freeze the system.
The institutions legally freeze redemptions. You cannot sell and you cannot transfer your assets out. You are trapped.
Wow.
And according to the legal structure, the retail investor is immediately reclassified as an unsecured creditor in a massive years-long bankruptcy proceeding.
That is terrifying.
Those digits you saw on your screen, that net worth you thought was yours, becomes legally meaningless.
You're at the very back of the line, hoping for pennies on the dollar.
Exactly.
And this brings us all the way back to the central banks hoarding the physical gold.
It does.
The document claims this exact scenario, this mathematical certainty of a collateral shortfall, is why the elites use Basel III to aggressively accumulate unencumbered gold.
Because you cannot default on a gold bar that is sitting in your own physical vault.
Right, it's just there.
It has zero counterparty risk. It doesn't rely on a digitized chain of custody or a centralized depository.
The entire paper system can evaporate, the prime brokers can all go bankrupt, but the physical asset remains intact and fully valued.
Exactly.
So what does this all mean for the listener? I mean, we've just walked through an incredibly dense, almost dystopian architectural view of the global economy.
We have.
Does the source material offer a survival strategy? If this systemic contagion is baked into the cake, what is the individual supposed to do?
Well, the text does distill a very specific, actionable strategy based on its findings.
Okay, what is it?
The core advice is that you must mirror institutional behavior, not retail behavior.
Do what they do, not what they tell you to do on the financial news.
Precisely that. The author suggests this begins with aggressively auditing your own exposure to hypothecated assets.
Okay.
You have to look deeply into your counterparty risk. Where is your wealth actually stored? What legal rights do you truly have if the institution holding it goes bankrupt tomorrow?
But is that actually realistic for a regular person?
It's a fair question.
How does someone with a standard 401k, a mortgage, and a couple of credit cards just opt out of the modern financial grid? It feels almost impossible to fully detach.
The document acknowledges the extreme difficulty. It doesn't suggest you can instantly abandon the current system.
Right.
However, it argues that the preservation of wealth in this coming paradigm shift requires intentionally transferring your financial energy out of trackable, hypothecated systems and into tangible, self-custodied assets as much as possible.
Meaning assets that you physically control and hold the undisputed legal title to.
Exactly.
It takes raw intelligence and deep psychological fortitude to do that.
It really does.
Think about the messaging we face daily. The algorithms on social media, the mainstream financial channels, they constantly mock tangible assets as outdated.
They call gold a barbarous relic.
Yeah. They push you constantly toward the newest digital token, the hottest tech stock, or the most convenient payment app.
It creates a tremendous amount of digital containment system.
Absolutely.
The authors imply it is the ultimate test of trusting the quiet historical data over the loud modern narrative.
We have covered some serious ground today.
We really have.
To wrap this up, the sheer scale of this Basel endgame theory is staggering to consider.
It is.
The idea that the very regulatory frameworks sold to the public as our protection, the laws designed to keep us safe after 2008, are actually the blueprints for financial containment.
Right.
The document makes a compelling, terrifying case that the system is engineered to keep middle-class capital trapped in a digital illusion, serving as exit liquidity for the megabanks when the musical chairs finally stop.
It completely reframes how one views the global financial news cycle.
It does.
And if we extrapolate from the document's claims about who is hoarding the physical assets, it raises a massive question about the future that wasn't explicitly spelled out, but feels inevitable.
What's that?
The geopolitical fallout.
Okay.
If Eastern central banks, places like China, Russia, and India, are the ones aggressively draining Western vaults of their physical gold,
Right.
and Western retail populations are the ones being locked into programmable digital fiat cages, what happens to global superpower dynamics?
Wow. Yeah.
When the music starts and physical gold is the only Tier 1 asset left standing, does the geographical center of wealth fundamentally shift from the West to the East?
That's a huge question.
Will the U.S. dollar's reign as the undisputed global reserve currency simply evaporate because the actual physical leverage has moved across the globe?
That takes the domestic threat of a CBDC and scales it up to a global shift in world power.
Exactly.
Definitely something to mull over. Are you holding the physical leverage, or are you just holding the digital token while someone else buries the gold?
It's the ultimate question.
We want to thank you for joining us today to unpack this highly complex document. It's heavy material, but you now have a clear view of the theories the text claims are hidden deep in the fine print. Until next time, keep digging and keep questioning the narrative.